Hello, savvy investors and market watchers. Welcome back to the channel where we deep dive into the fascinating world of hard-to-borrow stocks and short squeeze potential. Today, we're shining a spotlight on a company that's been lighting up our screeners with an absolutely eye-watering cost-to-borrow fee. We're talking about WLDS, Wearable Devices Limited. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's get into it. WLDS, or Wearable Devices Limited, is a microcap technology company in the consumer electronics sector currently sporting a market cap of just $5.06 million. Their innovation is truly intriguing. They are developing a non-invasive neural input interface, essentially allowing you to control digital devices using subtle touchless finger movements. Think about controlling your smartwatch or other electronics just with a flick of your wrist, without actually touching them. Their product concept amid its groundbreaking tech, and they offer modular development kits for wider adoption. But what makes WLDS particularly interesting to us right now isn't just their tech, it's the fact that it has appeared on our hard-to-borrow screener. What is cost to borrow and why each matters? So, what exactly does hard to borrow mean, and why is the cost to borrow fee so important? Imagine you want to short a stock. To do that, you first have to borrow shares from someone who owns them. This isn't free. You pay a fee, much like renting a car. This fee is called the cost to borrow, or CTB. When a stock is in high demand to short, or if there are very few shares available to borrow, the fee skyrockets. It can even exceed 100% on an annualized basis, meaning if you hold the short position for a full year, your borrowing costs would be more than the value of the shares you borrowed. A high CTB indicates intense interest from short sellers, a very limited supply of shares to borrow, or both. Why this stock is hard to borrow right now. Now, let's talk about WLDS. Our data shows an annualized cost to borrow fee for WLDS sitting at an astonishing 731.8%. That's not a typo. This is an extremely high number and a key reason WLDS is on our radar. The estimated float for WLDS is also quite small, at just 1.9 million shares. A small float means fewer shares are available for trading, which can amplify price movements significantly. We don't have current data on shares available to borrow, but this sky-high CTB suggests supply is very constrained. Our internal composite squeeze score for WLDS, which combines various factors, currently stands at 47.6 out of 100, indicating a moderate but notable setup. Show CTB and float stats on screen. Looking at recent price action, WLDS saw a significant drop today, down 18.99%. Over the last 5 days, it's down 19.50%. However, stepping back, over the last 30 days, WLDS is still up an impressive 26.98%. Volume today was 572,400 shares, which is relatively low compared to its 30-day average volume of 2,753,848 shares, putting today's relative volume at just 0.2x its average. This suggests less buying pressure currently, but those CTB numbers are still flashing red for short sellers. Squeeze mechanics explained. So with a stock like WLDS having such a high CTB, what's the big deal about a short squeeze? A short squeeze happens when the price of a heavily shorted stock starts to rise. This puts pressure on short sellers, who borrowed shares and sold them, betting the price would fall. As the price goes up, their losses mount. Add to that the incredibly high cost to borrow for WLDS, and holding that short position becomes extremely expensive. If the price continues to climb, and especially if the number of shares available to borrow shrinks further, short sellers can be forced to buy back shares to cover their positions and limit their losses. This forced buying creates a rush, pushing the price even higher, leading to a squeeze. Given WLDS's small 1.9 million share float, any significant buying pressure, especially from short covering, could potentially lead to very volatile and rapid price movements. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock's price will ultimately fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. One critical factor to consider with any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. More shares available can also provide an easier pathway for short sellers to find shares to borrow, negating a squeeze thesis. For WLDS, our check indicates no recent dilutive SEC filings such as -1s, -3s, or 424Bs found in the last 90 days. This is a positive sign for the short squeeze narrative, as there isn't immediate concern about new shares flooding the market then undermining potential price action. Recent reverse split watch. Another important piece of the puzzle for WLDS is its recent reverse stock split. On June 22, 2026, just 41 days ago, WLDS executed a 1-for-3 reverse split. What does this mean? Essentially, for every 3 shares an investor owned, they now own 1, and the share price is proportionally higher. Reverse splits reduce the total number of outstanding shares and, by extension, the floating supply available for trading. This can, in some cases, make a stock even more prone to volatility due to a smaller float. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split as the market adjusts to the new share structure. While WLDS has just passed the typical 1-month window, the recent reverse split is still a fresh factor that could contribute to continued price swings. This is a pattern we've observed, not a guarantee of future performance for WLDS. Before we continue, here's that crucial reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're tracking WLDS, what should you keep an eye on? First, continue to monitor that incredibly high cost to borrow fee. Any sustained increase or even stability at these levels shows continued pressure on short sellers. Second, watch for any data on shares available to borrow. A shrinking supply would be a significant indicator. Third, look for increased buying volume, especially on green days, which could signal accumulating interest. Fourth, pay attention to any company news from Wearable Devices Limited regarding their major platform or other developments that could act as a catalyst. Finally, remember that with its small float of 1.9 million shares, WLDS is inherently prone to large price swings, so volatility can be expected. WLDS, Wearable Devices Limited, presents a fascinating case study with its cutting-edge technology, extremely high cost to borrow, a small float, no recent dilution, and a recent catalyst of a reverse stock split. While the current price action has been down over the last 5 days, the 30-day performance shows that this stock can be quite dynamic. As always, this deep dive is for educational purposes only. Do your own due diligence. If you found this analysis helpful, please hit that like button, subscribe for more unique insights, and let us know in the comments what other stocks you'd like us to put under the microscope. Thanks for watching, and we'll see you in the next one.